Welcome to The Explainer, future A-star students. Today we're acting as your personal exam coach to entirely demystify manufacturing direct and indirect costs for the IGCSE Accounting 0452 syllabus. Now, to give you the ultimate edge, I'm going to be wearing two hats throughout this session. First, I'll be your subject specialist, breaking down the advanced technical methodology and those tricky cause-effect chains. Second, I'll be channeling my inner senior examiner, giving you the unvarnished truth about where students literally just bleed marks under pressure. We got a lot of ground to cover, so let's jump right in.
Okay, so here's our battle plan for today. We're going to start by laying down the A-star conceptual architecture. Then we'll move into the actual technical execution, elevate things with AO3 evaluation skills, and finally, finish up with some highly classified examiner warnings.
Right, moving to Section 1, the A-star conceptual architecture. To secure that top grade in the upcoming 2028 to 2030 syllabus updates, we've got to treat this module as high-level financial intelligence, not just data entry.
Now, Cambridge is basically demanding 100% accuracy with modern international terms. The days of writing bad debts, yeah, they're gone. It's now strictly irrecoverable debts, and you absolutely must use owner's equity. Please, whatever you do, do not lose easy marks by using outdated vocabulary. I mean, if you look at modern AI-driven platforms in the industry today, things like Xero or QuickBooks, they handle data using these exact international terms natively. Cambridge expects you to be industry-ready, speaking the modern language of finance.
So, the crucial point here is that you've got to completely internalize the duality of every single transaction. This is the business entity concept in action. This equation right here, assets equal liabilities plus equity, is the absolute bedrock of the whole shebang. If a manufacturing cost goes up, well, something else simply must shift to keep these scales perfectly balanced at all times during the fiscal period.
And, this is really where we separate the good students from the great ones. You need to master terms like accrued, prepaid, realization, and consistency. But above all, you must respect the prudence concept. In the manufacturing world, if you ignore potential losses or, say, overvalue your inventory, you completely violate the prudence principle. You're basically artificially overstating your profits. Think about the real-world consequences of that. You're distorting the financial transparency that banks, owners, and tax authorities desperately rely on to make their annual decisions. Not good.
Okay, so with the architecture in place, let's pivot to Section 2, Technical Execution. This is all about securing your method marks using advanced technical methodology.
So, this step-by-step procedural logic is your tactical game plan to minimize errors and seamlessly transition to those final financial statements. It's like a pipeline. It always starts with identifying the correct business document, like an invoice or credit note. That feeds your books of prime entry, which then populate your T accounts, which, by the way, are the absolute gold standard of the double entry system. You've got to relentlessly practice balancing these, knowing exactly when to use balance brought down versus balance carried down, all the way through to a totally flawless trial balance.
Now, let me put my senior examiner hat on for a second, because here's the ultimate secret. Listen closely, because this is literally how you save a disastrous exam paper. Method marks. Examiners will heavily reward your visible logical flow, especially for complex, multi-step adjustments, like depreciation or inventory valuation. And get this, they do it even if your final answer is wrong. If you make a tiny math error early on, but apply the correct accounting principles afterward, the examiner will carry that error forward and award you the method marks. So never, ever leave a calculation blank. Show every single step of your workings clearly.
You also really need to watch out for common mathematical pitfalls here. A classic trick question we see all the time involves calculating both trade and cash discounts in a single transaction. Miscalculating the difference, or even just the sequence of them, will totally throw off your entire T account structure. So if you need a quick memory hack for exam pressure, remember the mnemonic TBC, trade before cash. Always deduct the trade discount first to find the actual invoice value, and only then calculate the cash discount on that new subtotal.
All right, moving on to Section 3, AO3, Ratios and Evaluation. This is where your investigative and practical skills get truly tested.
Okay, imagine you're sitting in the exam, evaluating a manufacturing firm, and you see their current ratio plummet like this. It goes from a nice, healthy 2.5 to 1, crashing down to a really dangerous 1.1 to 1. You have to immediately step back and ask yourself, why did this happen? See, you can't just casually state that liquidity worsened. That's not enough. You must hit the examiner with rapid-fire analytical thinking, debating the root cause in a clear cause-effect chain. Is the business holding way too much raw material? Did they overpurchase inventory? Are trade payables just being settled way too slowly? Or, hey, maybe their cash reserves were entirely wiped out by a massive piece of capital expenditure, like buying a huge new factory machine. This is exactly the level of investigative reasoning required for those full AO3 marks.
Furthermore, when you're making inter-firm comparisons, you've got to be highly critical, because businesses use different accounting policies. Like, say, one uses straight-line depreciation while another uses the reducing balance method. Direct numerical comparisons are actually really tricky and sometimes totally misleading. So you have to evaluate the true quality of the profit by looking at non-financial factors. Things like staff morale, factory location, and market reputation. They don't sit neatly on a balance sheet, sure, but they massively impact the firm's long-term sustainability and return on capital employed.
Let's wrap up our coaching session with Section 4, Examiner Warnings and Insights for the 2028-30 syllabus.
Please do not let mundane issues sabotage all your hard work. I mean, if the examiner literally cannot read your handwriting in the ledger accounts, they can't award you those precious method marks we just talked about. And functionally speaking, the most common pitfall we identify year after year is the failure to distinguish between revenue expenditure, like everyday machine repairs, and capital expenditure, like actually buying the machine itself. Actually, scratch that. It's not just a pitfall. Mixing those up completely destroys your profit calculations from top to bottom. To combat this, I want you to adopt an absolute, non-negotiable routine before you walk into that Paper 2 exam room. Let's call it the WIST protocol. W stands for workings. Show all of them. Constantly document your evidence. I is for irrecoverable debts. Use the exact updated terminology. S is for state symbols. Watch them carefully in your manufacturing accounts. And T is for time management. You've got to allocate your minutes strictly according to the mark weightage of the question. To finish up, I want to leave you with a challenging pause and think scenario to chew on. If a firm's current ratio plummets because of heavy capital expenditure, but at the exact same time staff morale is absolutely peaking, how does the prudence concept dictate we report this reality? It perfectly bridges the rigid, conservative numbers with the very real, non-financial reality of a motivated workforce. Master that delicate balance. Actively apply the procedural logic we've covered today, and I promise you that A-star grade is well within your grasp. Keep practicing those T accounts, and we'll see you in the next explainer.